Well, hello everyone, and welcome to the YouTube live. And we'll usually we'll do the usual thing, which is to talk for an hour. And the goal is to answer as many questions as I can in that period of time. But obviously, if you're somebody that's one of our YouTube supporters, and also if you're willing to do a paid question, so super chat, then you also get pushed to the front of the queue, and we'll answer your question before everybody else. So that's the way it works. And usually there are lots of super chat questions and member questions in particular. So I'm sorry if we don't get to your question, but I'll try and go through them in order once we've worked through the people who support us. And if you're not a supporter and you want to become one, then all you have to do is click on the join button underneath this video, and then you'll be able to ask a question with the kind of priority that goes with your name. And I think there's
Still getting it into the Snapchat.
yeah, so I'm going to answer some of the questions, because what you'll hear is Laura's voice piping up in the background, because Laura kind of tells me to do things. And so if that's the voice you hear, it's Laura, who is my partner, and she's going to be prodding me as we go through the YouTube live. So don't be confused if you hear Laura. Right, the first question is from Gary, who is one of our supporters. Thank you, Gary. And he says, with the talk about the USA market being overpriced, I can see the bull market carrying on in part due to the new space race. Ooh, to the moon and onto Mars. Maybe the new space station thrown in. This will cause technology jump forward and industrial output to increase. Also, the West military build-up to counter China, UK's first carrier fleet heading to the South China Sea since World War II, USA Marine aircraft and personnel embarked too on the UK carrier. The tech for these, or the new energy, should be included too as positive growth. Do you think that these factors are being taken into account, or is Tesla, SpaceX, being ignored because of the market's negative view of Elon Musk and his peer group? Shouldn't the population decline be more of a worry? South Korea is on track for its population to halve in one generation. China and developed countries have similar population problems. Okay, loads of questions there. Let's start off with the space race. I think, the way I think of the space race is similar to the colonization of America by the UK, by England, in the 1600s. Now, initially, there were just a few trips to the Americas, which were just exploratory trips, and it took a long time for that to turn into regular trade routes between the UK and America. And once the first colony was established, it failed, right, due to a disaster that nobody quite knows the reasons for. In fact, I went to Williamsburg as a young boy, and it was fascinating to look at those first colonies and some of the colonial buildings and the food they ate. But I think the process by which we establish ourselves on the moon and on Mars is going to be similar. Initially, the exploratory missions, which are very expensive, many of which will fail, and ultimately there could be many deaths because it's a very risky business going to Mars and establishing a base. And then once there's a regular round trip between Mars and the Earth, then I think you might think about investing. But the earlier investors, I think it's going to be a real problem, because the narrative will be very attractive, which is that, look, you can invest in an entirely new world. But the truth is that I think the actual profitability of that venture will be very limited, because initially it'll just be a money pit, because the actual payoff of being on Mars is limited. You have to establish an infrastructure there. You have to create a safe environment for people to live. And then ultimately you can start to think about using the resources on Mars, which you wouldn't have on Earth. And I suspect that's going to take a long time. things like mining in space, I think might be more immediately profitable, where you go and find a nickel meteorite, you somehow mine it, and then you can send those resources back onto planet Earth. That, I think, would have a much more immediate payback. So that's why I think Martian colonization will not be profitable. Whether it's a good idea to do it as a species is another matter, because you don't want all of the humans on Earth to be the only humans in the universe. It would be nice to have a little bit of diversification in terms of residents as a species. But then your second question is about the military build-up and whether that's going to be positive. So firstly, it's certainly not a shooting war. Okay, it's not a shooting war yet. At the moment, it's very much in the flavour of the Cold War, where relationships are just getting a little bit more frosty. We're still a long way from a shooting war. And we're still a long way from something that was like a proxy war, which is what we used to see between Russia and the US, for example, in the 70s and 80s. We're not even seeing that at the moment. So I wouldn't overestimate the risk of a war at the moment. It is a threat. It's always a threat, but I wouldn't worry too much about that. And in terms of the impact on equity markets generally, I think it's minor, because the largest sector globally is tech, and that's not a military sector. And it's probably a good thing, right, that we don't depend on military spending, because that creates all kinds of perverse incentives to build up the military complex, which probably isn't good for us long term. But so the military aspect, I think, is not such an important one at the moment. That may not be true in the future, but certainly not yet. And in fact, strangely enough, I was just looking at the next video, which I just shot about a minute ago, where I was looking at equity markets during the Second World War. And what was very clear was that it had a negative impact on equity prices going through the Second World War. Not only that, but there was a post-war slump after the war ended. So it was several years, 7-8 years of negative, or at least a drag on equity returns. Some sectors obviously would benefit, the ones which are involved in producing materials for the war, but most sectors lost out. So let's hope that doesn't happen, because it's generally a bad idea, both, ethically, but also in terms of equity markets. I don't think Tesla's being ignored. Certainly, I mean, it's a private market, so it isn't a publicly listed share. SpaceX, I mean, but Tesla obviously is. But the share price of Tesla is still very high relative to its fundamentals. So I certainly don't think it's being ignored. And I think once SpaceX does do an IPO, there'll be a lot of interest. There are only a few funds at the moment which are buying into the private equity shares of SpaceX, such as Scottish Mortgage, which is a UK investment trust. Population decline, definitely a problem. And that's true that's true of China now, because it's no longer the case that China is a young population. They're aging quite rapidly because of the single child policy, which they've now eased. But that certainly is not a demographic tailwind for China. And that's also true of much of Europe. So kind of interesting at the moment, just over the last month, the Office for National Statistics in the UK showed that the number of deaths was greater than the number of births in the UK. I think that's the first time that's ever happened. That was partly because of the pandemic, but also because of a long-term trend, which is smaller population growth in the UK. So I think that is an issue, because obviously corporate earnings growth depends on how much stuff you can sell and how quickly you can grow that. And if there are less people, you can sell less stuff. So that's another reason why we want to be a multi-planetary species, because we're going to run out of energy and resources at some point. So yeah, that kind of feeds back to your first question. So yeah, demographics is a problem, and what I suspect is that countries which have better demographics will be a lot better long-term play in some cases. So places like sub-Saharan Africa, which at the current moment people don't even think about, but which my kids, if they start investing, probably will be on their investing radar. Okay, so that's Gary's questions. Next question is from Arsenio Cornelio Penesi. Gold Crown equals long-term supporter. Thank you, Arsenio. Thank you for that. Supporting us and doing it for a long time. I appreciate that. Because if you become a supporter on YouTube, you get a crown next to your name, and it changes colour such that if you do it for a long time, it goes gold. So Arsenio's been supporting us for a long time. Thank you, Arsenio. And I should mention, please subscribe to our channel because we're almost at 100,000 subscribers. We didn't quite make it, I suspect, for Laura's birthday.
Next week, still time.
We've still got a week to go. So if you subscribe, perhaps you'll be one of the ones that push us above 100,000. That would be great. But seriously, that way you won't miss videos if we publish them. And believe me, I bust my ass to make good videos. I really do. So Arsenio's question is about the equity premium puzzle. Is it really a puzzle? Is there a reasonable explanation? It seems research is not conclusive on it. I'm not sure what equity premium puzzle you're talking about. Certainly the equity risk premium, if people aren't aware, is roughly the extra money that you get investing in equity relative to a risk-free asset like cash. And the equity risk premium is generally, 6%, something like that, maybe more. If you inflation adjust it, it's about 6%. If you don't, it's about 7 or 8%. But it's generally very high, much higher than it is the risk premium than it is for bonds or things like property. So, but I'll tell you what, Arsenio, you ask a follow-up question and elaborate what you mean by the equity premium puzzle, and then I'll tell you whether it's a puzzle. Okay, I'm not aware of it though anyway. But certainly, if you want to look up the equity risk premium for a given market, then Aswath Damodaran's website is very good. Let me just quickly show it to you because I think that's a really good resource. Plus, he's awesome, and they call him the Dean of Valuation, and he's just great. He explains things really well, just really clearly, and he's also like a world expert on valuation. So let me put myself in the bottom corner and we'll look at Aswath Damodaran. And I like his website because it's worse than mine. There aren't many websites you could say that of, but here he is. And so he's got the implied equity risk premiums for various countries, and this is for the S&P 500. So if we look at the implied equity risk premium historically, this is what it looks like. And I hope I'm showing my screen. I think I am. Yes, I am. Good. You can see how it varies over time. And underneath it, you can see in dark blue is the risk-free rate. Now, the risk-free rate is a yield on 10-year treasuries. That's the rate he uses, at least. There's no agreement on that, but that's what he uses. And you can see in 2021, the risk-free rate isn't as low as it was. So if you go back to July 2020, it was only, well, it was much lower than it is now. It was less than 1%. I think it got down to 0.7. Currently, the yield is much higher, the risk-free yield on 10-year treasuries. That's also pushed up the equity risk premium. So that's gone up to, it peaked at around 6%, but it's been falling since. Now, if equity prices rise, generally the equity risk premium falls. So when equity is expensive, you generally get less return in the future, or a smaller return, because you're buying it in at a higher price. But you can see that equity risk premium has been pretty much falling since 2018, which is when it peaked. And now it's not at all-time lows, but it's certainly much lower than it was. It's much lower than it was. It was above 8%. Now it's around between 5 and 6. So I certainly think that it's interesting looking to see how he calculates it. He's got a whole spreadsheet, so you can see the assumptions he's making about earnings growth. And it's just a great learning resource if you go to his website.
I put an addendum on the comments.
Oh, there is an addendum on the comments, so let's have a look at what we meant. Okay, he's referring to the research of Mehra and Prescott. I understand that the return on equity should actually be much lower than it is. Oh, okay, I think I know what you're talking about. Right. So why is it so high? Why is the return on equity so high? I think historically it's been very high because if you actually look at where the share of corporate earnings that goes to companies versus capital, which is people.
You're still sharing your screen.
Oh, am I? I think I'm not sharing my screen now. No, I'm not. Okay. So if you look at the split of equity risk premium such that, look at actually what I'm talking about is looking at the share of profit of GDP which goes to companies and which goes to individuals. So you can imagine that companies can choose to pay their employees a lot of money, or they can pay back their shareholders a lot of money, either directly via dividends or indirectly via share buybacks, which pushes up the share price and gives a capital growth. Now the tilt very clearly recently over the last decade or so in the US, there's been a massive shift towards paying shareholders. So that's been great if you're a shareholder. It's been awful if you're an employee. And what we've seen is a stagnation of wages for a long period of time in the US, for example, unless you're the very highly paid senior executives. So I think part of the reason why we've seen such a great equity return is that I think a lot of the money's been given back to the shareholders and not to the employees, which has been good for shareholders and bad for labour. That may reverse, but there's certainly no sign of a reversal at the moment. Now, if people feel that companies aren't paying enough taxes, that there's too much of a tax burden for US citizens, which they're clearly, again, is shifted in the favour of companies and against individuals. If people start complaining about that and politicians pay attention, then it might change. But certainly at the moment, I don't see that trend changing. Companies are paying shareholders back, not their workers, and companies are paying very little in taxes in America. So the burden is on individuals at the moment, both in terms of high taxes and in terms of being paid less if they're not shareholders. And of course, the shareholders are generally the most wealthy people in society. So I think that's part of the equity risk premium puzzle. Personally, I don't know exactly what the causes are, but I think those are two candidates, certainly in the US. And if you look at other countries, for example, Italy and Spain, where there's probably a more equitable split with, labour's share of income versus companies, the equity performance has been much worse than the US. So I suspect that's a related fact, but I'm not convinced. I mean, I haven't done the research to ensure that's the case, but I suspect that's true. So back to the questions. Hisham, nice to hear from you. Another gold crown. Thank you, Hisham. Long-term supporter on YouTube. What are your thoughts about the price for oil over the next 20 years since we're shifting towards clean energy? Is investing in old school commodities not a risky investment in that regard? Well, I remember ever since I was 10 years old, people have been talking about peak oil. Obviously, we're now closer to it than we were then, 30, 40 years ago. But I still think that oil has a fair time to run. And the reason why I say that is because although the shift to electric cars, for example, has been quicker than most people expect, I still think there's a lot of momentum for fossil fuel usage. Maybe not so much in developed markets, but certainly in emerging markets where it's very expensive to roll out that infrastructure to transition from fossil fuels to clean energy. Now, in developed markets, a big part of the stimulus plan in the US is to increase the size of the network for electric cars so that there are more charging points so that the infrastructure can shift. But if you're in a very poor country, then it's going to be much more difficult to afford that and to change the infrastructure. So I suspect there'll be a long tail of countries which still depend on fossil fuels for a long time. And if that's the case, then oil prices will be supported by that for some time to come. And as the resources dwindle, it may be that pushes up the price of oil. So who knows what's going to happen to the price of oil? It's a notoriously difficult thing to predict. The two groups of things which are really hard to predict are currency, because it doesn't trend. It just kind of moves semi-randomly. It's kind of driven by rates, but not just by rates, interest rates. But another one which is notorious is oil, because a lot of geopolitical things drive the price of oil, supply and demand vary massively, and so it's really difficult to call. So could I forecast the price of oil for the next 20 years? I really don't think so. But what I would say is industries which are in decline might still be interesting as an investment. If you're morally okay with investing in energy companies, that might be a way to do it. Because remember, those energy companies will be undergoing a transformation. So initially you'll be buying an oil company, but in 30 years, I suspect it'll be a solar power company or a hydrogen power company. It must transform itself as we undergo that transition. Whereas if you buy the commodity, clearly that won't undergo a transition. So it might be better to go for the companies rather than the commodity. That's probably an automatic way to kind of ride the transition. But certainly, many of the metals which are used in electric cars are different from the metals that are used for internal combustion engine cars. And many of those metals are quite rare. So things like nickel or I did a whole explainer about this for members on PensionCraft, but I did a breakdown of the different materials which are required for the various different battery technologies. And it's really interesting to see how things like cadmium or really odd metals which have special properties like electrical properties, low resistivity, for example, where there's no alternative. You can't use anything other than those metals because there's no good substitute. So all I think will happen in terms of metal usage and demand is a transition from current metals to new metals. So I don't think that's going away. And it might be good to get ahead of the curve and look up that explainer, because I think you'll find it interesting. Plus, I really enjoyed making the explainer for PensionCraft supporters, because our Patreon supporters, that is, because it's kind of physics and I love physics. So yeah, that might be interesting if you want to look up kind of long-term commodity plays, because I think that is interesting. And certainly on my bucket list of things to buy during a crisis, I've got things like BAT, B-A-T-T, which is a fund that buys companies which are to do with battery technology. At the moment, it's quite expensive because obviously it's been pushed up in price because the narrative is sexy. But if equity markets sell off, that's definitely on my list of funds I'd like to buy. And commodities might also be on on that list, but more likely I'd go for the companies or funds. Carl Jung says, another Gold Crown person. Thank you, Carl. What's your opinion of target date funds? I'm nearing retirement and own Vanguard Target Retirement 2020, which is 40% equity, 60% bonds. What's a better allocation with less bond exposure? Right. So I can share my screen again so that you can see this. Okay. So this is my screen, hopefully, and what I'm going to look at is what I'm going to look at is Vanguard Target Retirement. Just so we can actually look at what's in these funds, which is kind of interesting. Plus there's a kind of broader story to tell here, which is really interesting. So this is what target retirement funds look like. And the idea is they're diversified. They change their allocation over time. So as you get closer to retirement, they reduce the amount of equity. So you start off age 40 with 80% equity, then it gradually reduces the amount of equity such that at the age of 75, the minimum amount is about 30% equity, 70% bonds. The logic being that you squeeze as much return out of equity markets when you're young, and you can ride the volatility, but then in retirement you don't run out of money because there's an equity market crash. I'll come back to that, but it's kind of an interesting thing to do. Now that's done automatically by target retirement. So if I'm, say, 20 to 23, in theory I'd buy the 2065 retirement fund, which is 80% shares, 20% bonds. If I'm 68, I'd buy the 2020, which is 50-50. Now the fee on these is very low, which I like, but gradually over time these things are de-risking. Now you don't have to use them for retirement. That's a kind of misleading name. You can buy these. So let's say you've got a son who's going to university in 20 years' time. Well, in that case, you could buy the 2040 retirement fund such that when he goes to university, this thing will have a small amount of equity and quite a bit of bonds. And it'll gradually reduce the amount of equity in it over time, so that when he goes to university there won't be a market crash and you'll be able to afford to pay him some kind of income while he's there. So that's the way these things work. Now if you want to have more equity, you can choose any one of these that you like. You know, if you want to have 100% equity or 80% equity, you'd buy the 2065 fund. You don't have to match it with your retirement, and it doesn't have to be anything to do with retirement, is my point. Now, another way to make it cheaper, because you see the fee for this thing is 0.24% per year. Another way to make it cheaper is to actually make your own target retirement with just two funds. So just buy a global equity fund, which you can do for about 0.1% if it's developed markets, and a global bond fund, which is again 0.1%, and the fee's much lower. And just match the equity bond split. The returns will be different, but it'll still be diversified and it'll still have the equity bond split that you like. And if you want some emerging markets in there, you can always throw some of that in, but it'll just be a bit more expensive. So that's another alternative. The other point I was talking about, which is kind of interesting, is that over time what happens is that when you retire, the point at which you're extremely sensitive to an equity market crash is just when you have the greatest amount of assets in your retirement portfolio, which is just when you retire, when you first start selling the assets in order to pay for your income. So that's just at the point of retirement. So at that point, you're maximally sensitive to an equity market fall. So that's the point where you might think about taking less risk. The irony is that you get a better outcome if what you do is sell the bonds first. So you sell all of your bonds once you've retired gradually. And then once all of the bonds are depleted, then you start eating into the equity. Why does that do better than selling everything in proportion? It's because equity has higher return than bonds over the long term. So the longer you leave the equity, usually the better returns you get. And by depleting the bonds first, you leave the equity alone to compound for longer. So the irony is that you actually end up increasing the risk of your portfolio to 100% equity as you get older, if that's what you do. But I did a whole video about portfolio rebalancing where I talked about that in a lot of detail. And the best strategy historically has been to use that approach. Sell the equity first and actually increase risk after you retire gradually, such that, you know, when you're an old man or an old lady, you actually have a lot of equity. And although that sounds rather odd, it tends to work very well. So, you know, that's just what the back tests show. So I thought that was kind of interesting to share in the context of your comment. So let me just switch.
Do you want to ask people to like?
Oh yes, please like our stream. It helps us, and also share our content via social media so other people know we're on the YouTube live now. And you can also subscribe and you can support us. And if you support us on YouTube, you get the nice crown next to your name and you get the joy of knowing that you support us. And my poor dog Teddy, who's starving here, he's so hungry, he's just passed out. Isn't that right, Ted? He's paying attention now because he thinks there's a treat in it for him. Oh yeah, you've powered up now, haven't you? You heard the word treat. Right. I've actually got some biltong, but that might drive him mad. Here you go, Ted. Here you go. Come on. You've got to work for it. Work, work. Oh, very good. Good lad. So yes, please do support us. And if you support us on YouTube, you get pushed to the front of the queue in these questions, the Q&As. I also try and answer your comments to the videos because we do look at your comments. And I do try and answer all of the member comments on YouTube. And yeah, so that's the benefits. And let's get on to some more questions. Okay. Thomas Crew says, connections between yield and valuation appear fuzzy. The 10-year bond just dipped and equities dropped 1.5%. It appears the market is becoming more adverse to uncertainty than yield. Interesting. Okay. Yeah, I think what happened with bonds is, I think the narrative about inflation being very high was a little bit overblown. And certainly if you look at markets at the moment, what they're pricing in for real yield. So if we look at Fred, and I'll share my screen in just one moment once I get the data. Oh no, that's not what I want. So let me just show you what I'm looking at, otherwise I'll just ramble without you seeing my screen. Okay, so this is what I'm looking for. Real yield Fred. So this is the 10-year real yield in the US at the moment. So this is, you can think of this as what markets are pricing in for inflation over the next 10 years. So you can see that at the beginning of 2021, there was this massive increase in real yield as inflation expectations increased. but then it kind of fell back, and it's been falling recently as well. So it's fallen back to minus 0.94. The highest value it reached recently was still pretty negative. It was minus 0.57, but it's fallen since then. So what that's telling me is that markets now no longer think inflation will be as high as they did. Now, why is that? Is it because they believe the Fed's narrative more? Is it because there's evidence that inflation isn't going to be super high? I think it's a combination of all of those things. Some of the bottlenecks that we've seen are starting to ease. Lumber prices, for example, other commodity prices are starting to fall, ones which had spiked. And that's obviously going to happen, right? There's going to be short-term bottleneck effects as the demand outstrips supply. But eventually, the way markets work is if there's a big demand increase, companies are going to increase supply. That's just the way the economics works. And so I do think it's going to be a temporary spike in inflation and that it was overblown. And I think that's what markets are pricing in. So I actually think what's happening at the moment is people are more worried about earnings and less worried about inflation than they were previously. So we'll just have to see what happens with earnings going forward. But again, I think what people might have overestimated is the upside of all the fiscal stimulus, the monetary stimulus. And when we get back to the kind of boring growth which we had before the pandemic, which is 2 or 3% GDP growth, earnings not growing by much, I think people will be disappointed. And if that's the case, then, valuations are still high and, we might see a bit of a pullback. But I think yields and tech are that's one sector that's very interest rate sensitive. And I suspect that'll remain the case. So certain sectors, I suspect, will still be sensitive to interest rates, and I think tech is one of them. And one of the reasons why tech has done quite well over the last 3 or 4 weeks is probably because of this real yield falling. I suspect that's the reason. That's one of the reasons. So I wouldn't rule out the effect of rates at the moment. But the thing to look at is real yield rather than nominal, probably. Next question is from A.G. Smith. Let me just check if I'm sharing my screen. I'm not. Good. Who says, re-yields. Can we talk about the rally in the 10-year? Yes, we can. Nobody talks about the rally in the 10-year, but I think we should. So let's look at that. So if I look for TLT, which is not the 10-year, and I chart it. So let me just bring that up. So what I'm showing you here is an ETF that buys 20-year plus US Treasuries. This is what it looks like. This is the chart of 20-year plus Treasuries returns in the US. Now you can see there was a pretty chunky fall between April 2020 and April 2021. So let's have a look and see how big that was. So peak to trough, that was about a 21% fall. But what we've seen since then is a pretty chunky rally of 11%. Now that's for the longest duration. If we look at intermediate duration, so that's the one you were asking about, which is the 7 to 10 year bonds, the fall will be smaller, but so will the rally. Oh, got carried away there. So if we just zoom in on the recent period, you can see that the rally is smaller. Instead of 11%, it's only 4% because the duration is less, and probably that part of the curve has moved less. And then the peak to trough fall was also smaller because of the smaller duration. So that was only 8%, the loss, peak to trough. So yeah, I think that rally is kind of interesting, and it's to do with this inflation narrative crumbling. And I think a lot of the people who are behind that narrative were people who have a vested interest because their favoured asset class would benefit from inflation. So cryptocurrency, for example, or gold, both of those groups of people generally favour the kind of narrative that inflation is going to be super high and fiat currency is doomed. But I personally just don't think that's true, or very unlikely to be true. So back to the questions. Yes, Lenin Velaturi is asking, who's also a gold supporter. Thank you, Lenin. We have lots of gold supporters this evening.
Okay.
Well, thank you all. Vanguard Factor funds have been closed now. Yes. Is there likely to be... Okay, I should say that's in the UK, not in the US. Is there like to like out there? Growth, value, etc. There certainly are. So if you want to find them, go to Just ETF, and let me share my screen again. And I'm already sharing my screen. So Just ETF. And one of the great things on this website, which is free, is categories. And one of the categories is themes. So for example, if you want momentum ETFs, you just click on this. If you want growth, you click on this. If you want value, I think there's value. There's certainly small caps and there's value. What there isn't is small cap value. I could only find one small cap value fund, which not all brokers have access to, which is a pity. But say, for example, you want momentum ETFs, you just click on this and, oh gosh, 2 ETFs were spoilt for choice. So we can sort it by cost. And the cheapest one is 0.25%. It's an X-Trackers one. There's an MSCI one, MSCI World Momentum Factor Tracker, which is created by iShares, so that's BlackRock. And you can see how it works. If it's one of the iShares ones, then iShares website is just brilliant. And you can look at the fact sheet for one of the ETFs and see what's inside it. So you can see the holdings. These are the stocks which are in it. So these will be stocks which were trending up over the look back period, which is usually about 6 months as far as I know. And you can see the geographic split. So 71% US with a smattering of other countries. You can see the sectors, financials, IT, industrials, very little consumer staples and energy, because those presumably have been languishing. So it's pretty transparent in terms of what it owns and how it's created. Now, if it's tracking the MSCI World Momentum Factor, what you can do is Google that index to see what it's doing exactly. And what MSCI do is produces brilliant fact sheets which tell you how the strategy works. So what it says is it emphasizes stocks with high price momentum while maintaining high trading liquidity, investment capacity, and moderate index turnover. Because one of the drawbacks with momentum is because the stocks are changing so often, you don't want to have to churn your index very often because that increases the management fee. So that's why they're being careful about that. But you can see that it's performed very well recently because momentum as a factor has performed well, better than global equity in fact. So global equity for developed markets is in orange, yellow, gold, and the MSCI Momentum Index is in blue. So momentum is a strategy that's worked well since around 2011, clearly. Okay, so that's how I'd find it. Find an ETF, find a cheap ETF, and then find the index which it's tracking to work out how it works. And then maybe think about buying it. So you can have alternatives to Vanguard. You just got to dig a little bit to find them. Back to me, and I'll switch back to the questions. So don't forget to like, share, subscribe, because we're almost at 100,000. What is it, Laura? I think it's 97,000. We just reached 97,000. Let's get our stats.
97,240.
97,240. We're getting close, getting close. Very good. Okay, next question is from Lenin Velatori. Nice to hear from you again. Another question. How's your research on crypto? Are you planning to do a basic guide video for PensionCraft viewers? There are plenty on YouTube, but difficult to know who to trust. Yeah, I might do a video about it, but I think my issue with doing a video about crypto is it's not something I know a lot about, not yet. I am learning, so the research, I'm doing the research by buying it and trying to learn about it in my spare time. But my latest experiment has been yield farming, so that's been interesting. I might share my experience. Certainly if the PensionCraft community asked me to produce the video, I probably would. Certainly the Patreon community might do that, but they haven't asked me, so I haven't yet. There has been talk on the crypto Slack channel in Patreon, but I'm certainly not planning to do a video about it in the near future, unless people ask for it. What I suspect is that it wouldn't be very kind of popular, because I generally find that for the people I make videos for, they're not really into crypto. And, maybe I should try and talk about it. But I just get the feeling that at the moment, there's so much content out there on crypto that I really wouldn't be adding much. So I'm not planning to do anything in the near future. But certainly people trust me because they know I wouldn't try and push coins or products. So maybe it's worth doing it for that reason. I don't know. Well, you tell me. Okay. So back to the questions. I think that's all of the ones from supporters. Oh, no, it's not.
Yeah, that's just a comment.
Oh, okay. Someone called... one of our supporters says, A.G. Smith says, I'd like to learn more about how Ethereum works. Great. Okay, so maybe that's a potential video, but yeah, if many people ask for it, I certainly would consider doing it. Okay, back to the questions, and I'm going to go back to YouTube. So I think we've finished the supporter questions. So I'll scroll back up to the top. Oh, a lot of gold crowns here. It's good to see. Okay. Okay. So there's a question from Carlos Gallardo, who says, did exchange traded funds on gilts and treasuries, so gilts are UK government bonds, treasuries are US government bonds where you're lending money to the government. It's very safe. Did they go down in Q2 2020? They certainly did. What are the pros and cons of them versus cash, just to keep some powder dry? So during the equity market sell-off, there was a kind of shaky period. Again, let me share my screen so you can see what I'm talking about. Yeah. So this is that intermediate 7 to 10 year treasury fund that we saw earlier. Now, if you look at what happened during the equity market sell-off, the immediate reaction was for the fund to rally. Why is that? Because when people are scared in the equity market, they buy safe stuff, they buy treasuries. But what was interesting was that it kind of had this judder as bond prices fell. Now that was really scary. It was scary for the Fed. It was scary for people who knew about bonds, because that really shouldn't have happened. And what it showed was that people were worried about treasuries and whether that market would hold up. So that's probably one of the primary reasons why the Fed stepped in so aggressively, because the treasury market is one market that can't afford to seize up. It's just so liquid, and it has to be kept that way because it is the risk-free asset class, probably the lowest risk asset class on the planet. So there was a bit of a wobble, but then you can see that things ironed out, and there was a very strong rally. So how much did it go up? So the intermediate bonds went up by 10%. TLT would have gone up by even more. So I don't know if I've got US Treasuries. No, I haven't. Okay. So if we look at TLT, which is the really long duration one, 20 years plus, that would have gone up more. And indeed it did. So that went up by 23% in March and April. So it was a very good equity hedge, in other words. But again, here's that wobble that I was talking about, even more accentuated in this case because it's got more duration and more volatility. Now, obviously there was a big sell-off as equity markets rallied and people were talking about inflation, but it has bounced back quite a lot since then. So I think if you're going to keep your powder dry, I'd be worried about putting it into something which is really long duration, like TLT, because if yield curves do rise, if growth is really high, if inflation does pick up a lot, then this thing will sell off a lot. So it might be safer to put it in shorter duration government bonds if you do want to keep your money safe. So obviously you'll get a smaller return, but you'll also suffer a smaller risk if you do get higher inflation or higher interest rates. But it's generally a good idea to keep at least some dry powder, because that way, if there is an equity market sell-off, you've got money to invest, which is a great thing to have. When equity markets fall and there's a sale, you want to have money so you can put it into the market. But obviously there's a drag on return the more cash you hold. So that's the trade-off. And it's really hard to time crashes, so it's hard to know when to build up your reserves. So that's the fundamental problem in deciding how much dry powder to have. But to answer your question, yes. I think bond markets, short duration bonds are probably a reasonable place to park your money for dry powder. Interesting question. Rushar says, might be a weird question, but why can't the Fed stick to low rates in a high inflation environment? So the problem, I think, is that now the standard thinking is that when the Fed lowers interest rates, it actually makes consumption more attractive right now. Whereas if interest rates are very high, it tends to make people defer their consumption. And the reason for that is that because if you can invest your money at 5% interest for a year, then you're more tempted to invest your money in a risk-free asset than consume it now, because you're going to have more money in future. So that's one of the reasons why, that's one of the pieces of logic behind lowering interest rates when inflation is low. Because the idea is that it makes people spend more, it stimulates the economy, and presumably increases inflation. And when inflation is high, it does the opposite. You take the punch bowl away, you reduce people's disposable income, and it should slow down the economy. So if it is the kind of inflation where it's driven by too much activity, economic growth being too hot, then in theory that should work. But, I think people are questioning this logic of the Feds, and I think people are thinking more now about fiscal policy and how that can be used to control inflation. So by fiscal policy, I'm talking about how much the government spends and what it spends on. So that's another alternative to controlling the economy and to controlling inflation. And taxation is another lever which the government can use. So if you read the book on modern monetary theory by Kelton, and her first name is Stephanie Kelton, on modern monetary theory, she talks about that really eloquently, about how fiscal policy can be used to control inflation, but also government taxation can be used to control it. And she's got some really interesting ideas on what to do during a crisis. But it's a brilliant book. I strongly recommend it. That's probably a good one to read, Rushal. Musa Absi says, if I have access to buy Alibaba stock from the Hong Kong stock market, what makes it different than the one in the US? Now, whenever there's an arbitrage opportunity, then two prices will be kept in check. Now, 100 years ago, you couldn't trade the same stock at the same time on two different exchanges, because you'd have to send a letter by post, usually via a steamer. It might take weeks to reach its destination. So, communications weren't instant. But nowadays, where hedge funds can have, a seat on two exchanges, they can communicate in milliseconds. That means that they can, let's say the Hong Kong version of a stock was cheaper than the New York Stock Exchange version, once you account for the foreign exchange conversion. You'd buy the cheap one, you'd sell the expensive one, and because they're so highly correlated, there'd be very, very little price risk, and you'd immediately monetize the difference between the two. And you just carry on doing that trade while the price difference lasted. And what happens is you'd be buying the one which is cheap, you'd push up its price, you'd be selling the one that's expensive, you'd be pushing down its price, and that would snap the two prices back into line. So that's called arbitrage. And arbitrage is the kind of, I guess it's the only rule in finance, which is that two prices must be the same if you can do the arbitrage trade, a risk-free trade, to bring them back into line. So I think that's why there's not usually an opportunity to do the arbitrage if you're a small investor, because the big players will have found it and done it already. Now, in some cases, that's not true. So, for example, in cryptocurrency, there was a big arbitrage opportunity between the futures market, I think, and the spot market, where you could buy cryptocurrency, you buy Bitcoin, and the futures price would either be above or below that spot price. And because the two are highly correlated, effectively this would be an arbitrage trade. And it didn't dry up because of the difficulty, the illiquidity in one of those markets. I can't remember which. So illiquidity, the difficulty of buying and selling, can sometimes create mispricings. If you're in a special situation where you can do the trade that other people can't do, you may be able to do the arbitrage, which big players can't. So there are arbitrage opportunities, but I suspect for stocks, you won't find it. It'll be hedge funds that do that. But there are special cases where you can find arbitrage opportunities. And it's usually small niche markets where big players can't get involved. But I think that one in crypto has actually reduced the kind of difference between the futures and the spot price. But it's an interesting question. Thanks for asking that one. So anyway, we've run out of time. It's now 8 o'clock. Thank you for spending your hour with us, all of you. So it's nice to see so many people on the call, on the live stream. Mustn't call it a call. And don't forget that you can share this stream. You can like us, and you can subscribe to our channel, because we're pretty close to 100,000. And thank you all for spending your time with us. And we'll see you in 2 weeks' time. So take care, everyone. Bye-bye.